Welcome to Milestone Investing Market Intelligence Bulletin. This week's ex-dividend date is the 20th of June, 2024. Let's jump straight in and find out what companies we've got this week. We have 5 companies: United Utilities, Persimmon, 3i Group, Experian, and Airtel Africa. Between them, they promised to pay nearly 1.1 billion. And in terms of return on investment for professionals, we're looking at returns between 10 and 63, or between 4 and 16 for non-professionals. Let's get started with the first one. United Utilities is a water and waste company. The company is engaged in providing water and wastewater services in the northwest of England. It collects its water from a range of different services or different sources, but predominantly from its reservoirs in the Pennines and the Lake District. It extracts water from Lake Vyrnwy in Wales for customers in Merseyside and Cheshire, while the rest is taken from the River Dee, boreholes and streams. It collects and treats wastewater from 3 million homes and 200,000 businesses from as far north as Carlisle all the way down to Crewe. Cumbria's Thirlmere and Haweswater are its reservoirs. Haweswater holds more than 84,800 million litres of water. It owns and manages over 56,000 hectares of land. The majority of this land surrounds its reservoirs. It operates over 79,000 kilometers of wastewater pipes to transport wastewater from sewers to one of its 584 wastewater treatment works. It supplies about 1.8 billion litres of water every day. This company is run by the CEO, Louise Beardmore, supported by Phil Aspin in the role of CFO. This company pays dividends 2 times a year. They're number 17 in the FTSE 100, and they got a valuation of 7 billion. In the last 12 years, had you bought this company's shares for its dividends, you would have had 25 opportunities to do so. 5 times out of 25, which is 20% of the time, had you gone long, you got your money back in a week. 10 times out of 25, had you gone long, you got your money back within a month, which is 40%. And 10 times out of 25, it took you more than a month to get your money back, again 40%. And in that 12-year window, there were no times when you didn't get your money back at all. What about going short? 15 times out of 25, 60% of the time, you made money on day 1 going short the Thursday. And 16 times out of 25, 64% of the time, made money on day 1 the Friday. So if I just pause there for a second, this is leaning short and away from long. So instantly we know what to do with this one. If we go to if we deep dive these numbers, we're going to see that we've got a final coming up. The previous final dividend in 2023 took 126 days to recover, 61 days falling, 65 days rising. You didn't make money on the first 2 days, but after that, you were clearly in a good situation. 2022, this was a quick recovery. 4 days to recover, hit the floor on day 0, which is a Thursday, and bounce back by Monday, which is day 4. 2021, 18 days to recover, 6 days falling, 12 days rising. 2020, 291 days, 228 days falling, 63 days recovering. If we go back only 3 of them, which is that one, this one, and this one, we have an average, 49 days. 22 days falling, 27 days rising. If we look at their fundamentals, we've got 1.9 billion, falling slightly to 1.8, rising slightly to 1.9, falling slightly to 1.8, rising to 2 billion. When I was saying 1.8 or 1.9, I meant 1.9 billion. In terms of profits, they generated in 2020, 303 million, which rose the next year to 551 million, dropped back a bit to 440 million, dropped again to 256 million, dropped again to 170 million. If we look at the profit margin, this will tell the tale. We're converting revenue into profits at a rate of 16.3% in 2020. That jumps up to 30.5%, drops to 23.6, drops to 14, drops again to 8.7. This is an example of relatively fat revenues and increasing costs due to inflation. So this looks like an inflationary stimulated poor performance, as well as maybe management not being able to keep their finger on the pulse. But this is, I would say, mostly their margins are being hurt because of inflation. And they've got flat revenues and rising costs. And that's what's causing this. If we look at their capitalization, we've got a company that's basically worth between 6 and 7 billion to buy on the stock exchange. And if we compare this 7 billion to the 2 billion value of the net assets on the balance sheet, this company is trading at 3.4 times their book value. And if you compare that to the previous times, it's between 2 and 3 times book value is what they trade at, the share price trade at. If we compare that to the profits though, revenue to earnings, sorry, beg your pardon, if we compare this number here to the earnings or the profits, we've got a number of 55. In 2024, previous year was 35, 2021 was 14, and 2020 was 58. So this company would appear to be overvalued. This share price is too high. That's how what it would seem. The share price was good when it was £9, and their profit was $500,000. But now their profit has decreased quite a bit, and the price of the share has gone up since that time. But it is on the decline because it was at its highest point in 2022, and it's been slipping since then. But despite that slippage, that is too high relative to this earnings. If we look at the share price here, we can see 2017, 2018 was a downtrend, and then from there it's been going up, 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 up. Well, this was up, then kind of down. That was a COVID year, up, and then we had an adjustment in 2022, up, down, up, down, up, and then 2023 couldn't go much higher, up, down, up, and then 24 slipping. Now this is all because the share price is moving too fast relative to the business ability to generate profits. That's why this is struggling to keep rising. There's a ceiling that it can't go beyond, because if it does go beyond there, it becomes more and more and more overvalued, the share price. Okay. Persimmon is a UK-based house builder serving local markets with 30 offices across the country and 3 off-site manufacturing facilities. The company operates from 30 regional offices throughout the UK, trading under the names of Persimmon Homes, Charles Church, and Westbury Partnerships. The company operates 3 off-site manufacturing facilities, Space4, Brickworks, and Tileworks. Its Persimmon Homes brand delivers a range of traditional family housing throughout the UK in places where customers wish to live and work. The Charles Church brand complements and differentiates itself from Persimmon by delivering high-spec homes in locations across the UK. It builds homes under this brand tailored to local markets. Its Westbury partnership focuses on affordable housing, social housing. The Space4 business operates an off-site manufacturing plant, producing timber frames, insulated wall panels, and roof cassettes. What they're telling us in this body of text is that this company is vertically integrated. What does that mean? It means that the things they need to buy to build houses, they own those companies that would make those things. So they own the company that makes the woodwork for building homes, insulation panels for building homes, the roofing for building homes, the brickworks for building, tile works for building. So they actually own the things that you'd have to buy to make a house. They own those companies. So they basically have they got the materials they need, obviously, and then they got the product that they make from those materials. And so basically they're vertically integrated. But what does that mean? It means that therefore they can keep the costs low to build a home, or at least under control to a degree. Dean Finch is the CEO. Andrew Duxbury is the CFO. This company pays dividends twice a year. Now, we'll discuss that in a minute. This company pays dividends twice a year, and that's only of recent times. They're number 87 in the FTSE 100. They got a valuation of 4.7 billion. In the last 13 years, how you trade this company for its dividends, you would have had 21 opportunities to do so. 6 times out of 21, which is 29% of the time, had you gone long, you got your dividend and your money back within 1 week. 4 times out of 21, you got your money back within a month, which is 19% of the time. 8 times out of 21, which is 38% of the time, you got your money back after a month. And in that 13-year window, there were 3 occasions when you did not get your money back. So had you gone long, your share price did not go above what I call the finishing line. And this happened on 3 occasions. 1,060 days ago, 829 days ago, 731 days ago. What about going short? Well, 8 times out of 21, you made money on day 0, 38% of the time. And 10 times out of 21, which is 48% of the time, you made money shorting on Friday. So let's do the same thing we did with the other company. We can see 29 days means this is not good for going long, and 38 to 48 means it's not good for going short. So this company is not really a dividend fishing friendly company. So it's fair to say, I would say avoid this one. Don't bother wasting time try and pick up dividends or going short. It's not user friendly from either direction. If we look at this, we can see that we're in the finals. The previous final was 15 days, hit the floor on day 0, which is the Thursday, and then it took 15 days to climb up. You can see that for the first, few days, you're in losses. Okay. Now, if you look at the previous finals, there aren't any. And that's because they've changed the way they actually label what they call their things. So at one point, they were doing special dividends, and that was basically here it was one a year. And then in 2017, it was twice a year. And then in 2020, they paid dividends 3 times a year. 2021, twice a year. 2022, twice a year. 2023, twice a year. And so they've gone into that. But they've been labeling it. And so the question is, what would you argue would be the equivalent of the final? Now, you could argue that this is the final and that's the final. And if you look over here, interim final would seem to be correct. But then you come here, interim final, that's not a good argument there. And then you might say, so what's going on? And the answer is, you're just going to have to start again. And so you can argue that we don't have enough data on what they call final dividend. And we have to basically just give them time to build up some pattern so we can understand how to assess this. But on the whole, it's not good for going long. It's not good for It's not good for going short. So this one, give this one a miss. But just for completeness, let me tell you about the company anyway. We've got revenue in 2019, 3.6 billion, falling to 3.3 billion in 2020, COVID year. And then it jumped back up to 3.6, 2021, 3.8, 2022. And then 2023, we had some issues around the revenue growth. It basically went from a growth trend into a declining trend in 2023. Profits, 1 billion, 2019, 784 billion, 2020, big drop. Then it starts to rise up, 967 million, falls back to 731 million, falls heavily, 352 million. Profit margin. We're converting revenue into profits at a rate of 28.5, falling to 23.5, rising to 26.8, falling to 19.1, falling to 12.7. Now, it's easy to say this is cost control, but it's a combination of cost control and here slipped revenues. Because when your revenues drop heavily and you've got these fixed overheads, those fixed overheads begin to hurt you. The fixed overheads hurt you big time when you have a big drop in revenue. And so that's what's hurting them and their ability to convert at a rate that is that would appear to be under control. Is it completely under the control of management and the director of finance? Maybe not. They do have a part to play, but I would argue that, yeah, there are things outside of their control, and they're basically, it's almost like you I don't know, you go fishing and you want to pull out, I don't know, some fish that's manageable for your particular body size and strength. And then a whale grabs hold of your bait, and that whale is way too strong for you and it's pulling you under or pulling your boat around. And that's an example here. There are external forces that is really management are struggling with. And even though if you're a brilliant manager, if you're under the wrong circumstances, like with the whale on the end of your, grab hold of your bait, even if you're Arnold Schwarzenegger, you're going to struggle to maintain your composure and reel that thing in. Let's look at their capitalization. You got 4.4 billion. You got net assets of 3.4 billion. So they're trading at 1.3 book value. If you compare that with the previous times, 1.1, 2.5, 2.5, 2.6. So you could argue this is a good price. This is a good price. P ratio. Now this is comparing the price of the company or the capitalization to the profitability of the company. And we've got a 17 here. Now, I think I've shared with you already, the numbers between 13 and 20 is considered to be the sweet spot. That's correct. 13 to 20. 17 is correctly priced. 7, this price was cheap. at that time. 12, slightly cheap. 14, correctly priced. 10, cheap. So you got 3 cheap ones and 2 correctly priced ones. This, I wouldn't say it's selling at a discount, but you're getting a decently priced company. They're not taking the mickey with their pricing. Share price rising, falling, big spike up. COVID hit that one and brought it down, only to recover again. Then 2021, you saw the beginning of, and the second half of the year, the beginning of the fall. 2022, it kept on falling and then it plateaued in the last quarter. Then it went sideways for 2023, up to a bit and gone sideways again. Free Group is a UK-based investment company which is specialized in private equity and infrastructure. It invests in mid-market companies. Its private equity business includes investment and asset management to generate capital returns and is focused on consumer, healthcare, industrial technology, and business and technology services. Its infrastructure business invests in a range of economic infrastructure businesses and operational projects in Europe and North America, in sectors such as utilities, transport, stroke logistics, communications, natural resources, stroke energy, social infrastructure, and healthcare. If you notice, all of these companies are practically recession-proof. Utilities, electricity and water. In a recession, you're still going to use electricity, you're still going to use water. In terms of in a recession, transportation and logistics, getting food, getting goods from one location to the other, or getting people from one location to the other, that still has to happen, regardless of what the economic climate is. Communications, we don't stop talking to each other or communicating during the recession. And then we've got natural resources and energy. Well, you're still going to need that in a recession. And then you got healthcare. Well, even in a recession, if you're sick, you're still going to look after yourself or do the best you can. So they're relatively safe areas that may not be brilliant in a boom market, but in a bear market, my God, these guys are almost like they're recession proof. But let's see if that's true. They pay dividends twice a year. They're number 23 in the FTSE 100, and they got a valuation of 28.6 billion. And in the last 12 years, had you traded this company for its dividends, you'd have had 25 opportunities to do so. 9 times out of 25, which is 36% of the time, had you gone long, you got your money back within 1 week. Had you 8 times out of 25, that's a bit of a typo there, so I do apologize. 8 times out of 25, had you gone long, you got your money back within a month, and that's 32% of the time. And 8 times out of 25, again, 32% of the time, you got your money back after a month. And had in that 12-year window, there were 0 occasions when this company did not give you the opportunity to get your money back. What about going short? 15 times out of 25, 60% of the time, you made money going short on Thursday. 14 out of 25, 56% of the time, you made money going short on the Friday. So this company is leaning more short than long. If we look at the finals, you got a 35-day recovery in 2023, 4 days to hit the ground, 31 days to recover before it goes to the finishing line. What's the finishing line? The finishing line is the highest point on the qualification date. 2022, 21 days to recover, 6 days falling, 15 days rising. 2021, 36 days to recover, 33 days to hit the ground. and 3 days it sprinted up and recovered very quickly. 2020, 50 days to recover, 14 days falling, 36 days rising. So you can see straight away, this is not really brilliant for going short. But let's have a look at sorry, it's not good for going long, beg your pardon. But look at it, let's look at what it looks like going short. Here, all black numbers. Day 0, day 1, black numbers. 2021, black numbers. 2023, black numbers. So this one is good for going short. It's good for going short. Fundamentals. 3i Group, 285 million in 2020. That fell to 93 million in 2021. Bounced up to 331 in 2022. Up again to 332 2023 and 396 million 2024. Because this is an investment company and they can be selling assets and all kinds of stuff, you know, this has profits larger than revenue. And so it looks kind of weird, especially when you come to looking at the profit margin, which we won't even bother to look at. But we'll go 216 million, 1.9 billion 2021, 4 billion 2022, 4.6 billion 2023, 3.8 billion 2024. So you've got profits rising, 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 and then dropping back a bit. Revenues. We've got capitalization of 27 billion. That's compared to a balance sheet of 20 billion. That means they're trading at 1.36 balance sheet in book value. If you compare that with previous years, 1.31111. Investment companies tend to be valued at the book value. And you can see that here. When you compare profits to the revenue, we're looking at a P ratio of 7.436, and then this was 36. So here, that's above 20, and these are all below 13. So this would appear to be good value for money. Share price. 2017 rising slightly, 2018 flat, 2019 rising, 2020 the COVID quarter was down and it rose from there, rose again in 21, and then it corrected in 22, and then 2023 it went crazy, and 2024 it's on that same trajectory. Experian is a global information services company. Its business segment includes business to business and consumer services. It builds and manages large and comprehensive databases. It collects, sorts, aggregates, and transforms data from tens of thousands of sources to provide a range of data-driven services. Its data and third-party information, including clients' own data, to create and develop analytics, predictive tools, software, and platforms. Its services help its clients improve the consistency and quality of their business decisions in areas including credit risk, fraud prevention, identity management, customer service and engagement, account processing, and account management. It provides credit education, identity monitoring, and fraud prevention services directly to consumers in America, Brazil, UK, South Africa, Peru, Colombia, and India. This includes free access to their Experian credit report and score, and useful online educational tools. Brian Cassin is a CEO, supported by Lloyd Pinchford in the role of CFO. This company pays dividends twice a year, They're number 18 in the FTSE 100, and they got a valuation of 34 billion. In the last 12 years, how you trade this company for its dividends, you'd have had 25 opportunities to pick up those dividends. 13 times out of 25, which is 52% of the time, you got your money back within a week. 8 times out of 25, 32% of the time, you got your money back within a month. And 4 times out of 25, 16% of the time, it took you more than a month to get your money back. And in that 12-year window, there were no occasions when this company did not give you back your money within that time frame. What about going short? Going short, we can see that 14 times out of 25, 56% of the time, you made money going short on the Thursday and also on the Friday. If we back up a bit, going long, 52. Going short, 56. This is literally 50-50. Literally. It's a toss of a coin. Let's have a look down here. Finals. 2023 final, 6-day recovery. 2022 final, 1-day recovery. 2021 day finals, 8-day recovery. 2020 finals, 4-day recovery. 2019 finals, 5-day recovery. So if I go back to the last 3 years, 1 week, I'm sorry, start again. 1 week, 1 week, within 1 week, within 1 week, and just over 1 week. So the average is going to be obviously a week. Okay. What does it say here? The average is 5 days in the last 3 years. Hits the floor on day 0, takes 5 days to rise. If you look at all dividends, because of these 2 outliers, this one and this one, you got a 28-day fall, 120-day rise, and 148 to complete. Now, what this is saying is you can go long, but it also has the ability to mess you up if you do so. And remember, we had that big drop on, we also, so it was good for going short. So if you look at this one, all black numbers, which is good. 2023, 2021, when 1-day recovery, it was a mess for going short. And then in 2021, it was horrible for going short. So really, going short is 1 out of 3 in the last 3 years. And going long is 3 out of 3. Experian looks like, based on the granular fine tuning, that this might be a good one for leaning long and away from leaning short. And why is it so? Because it hits the ground quickly. Hits the ground day 0. Hits the ground day 0. Hits the ground day 0. Okay. And unless it hits the ground hard and falls heavy, there's not much room for money. Okay. You don't like get 3 or 4 days. So this one looks like it might be good for going long. Experian. Let's look at their fundamentals. We've got 5.2 billion, rising to 5.4, rising to 6.3 billion, rising to 6.6, rising to 7.1 billion. Revenues are rising year on year. Profits, 942 million, rising to 1.1 billion, 1.4 billion, falling to 1.2, rising to 1.6. If you ignore this one, if you ignore that one, we are in a rising trend with profits. If we look at the profit margin, we can see 18.2, and this is the ability to convert from revenue into profits. So we got a profit conversion from revenue, 18.2, rising to 20, rising to 23, rising to 21.9. This is the one where it kind of messed up their nice upward growing trend. And obviously they had a challenge in this particular year, which shows up here and it shows up here. If we look at their balance sheet, I'm sorry, look at the value of the company, 29, let's call that 30 billion. We've got net assets of 4.7. They're trading at 6 times balance sheet. Previous to that, 6, 7, 7, 9. P ratio, comparing the price of the company, which is this number here, to the earnings of the company, which is the profits. And we've got 25, 32, 24, 28, 30, all of which is above the 20. So this company is really a good company from an investment perspective. And obviously everyone thinks so because they pushed the price up, and it's price basically selling at a slight premium because of that. Share price rising, rising, down, up and down. First quarter of 2021 was down, and then it marched up. Then it corrected in 2022. It fell back, and then it took and basically add some more, gave back some basically benefit that what he took away from you the first half of the year. This one was down, up, and then up. And then 2024, we've now got a positive upward march. Airtel Africa is a UK-based company, which is a provider of telecommunications and mobile money services. The company operates through 4 segments: Nigeria, East Africa, and Francophone Africa. It did say 4, didn't it? Nigeria, East Africa, and Francophone Africa. The Nigeria segment comprises mobile service operations in Nigeria. The East Africa segment comprises mobile service operations in Kenya, Uganda, Rwanda, Tanzania, Malawi, and Zambia. The Francophone African mobile service segment comprises mobile service operations in Niger, Gabon, Chad, Republic of the Congo, the Democratic Republic of the Congo, Madagascar, and the Seychelles. The mobile money segment comprises mobile money service across the company, including payment service bank in Nigeria. It offers pre- and post-paid wireless voice services, international roaming, and fixed-line telephony services. The data services provide a suite of data communication services, including second generation, 2G, 3G, and 4G. Olusegun Ogunsanya is a CFO, and Jaideep Paul is a CFO. This company pays dividends twice a year. It's number 89 in the FTSE 100, has a valuation of 4.6 billion. How do you trade this company in the last 4 years? You'd have had 9 opportunities to do so. 4 times out of 9, which is 44% of the time, you got your money back in a week. 5 times out of 9, 56% of the time, you got money back in a month. And in that 4-year window, there was no occasions when this company did not give you back your money. What about going short? 4 times out of 9, 44% of the time, you did well going short on day 0. 5 times out of 9, you did well going short on day 1, Friday. These two numbers are identical: 44, 44, 50, 56, 56. Again, another 50-50 model. Let's deep dive and see what's going on. We're looking at finals. 84-day recovery. 15 days falling, 69 days rising. 4-day recovery. Hits the ground on the Thursday and it recovers on the Monday. 15 days to recover, 6 days falling, 9 days rising, 4 days to recover. Again, hits the ground on Thursday, recovers on a Monday. So you got 2 times it recovers in this last 4 years. 2 times recovers within a week. This recovers in 2 weeks or just over 2 weeks. And this recovers nearly 3 months. What I can say about this is that the numbers are just all over the place and there's no direct pattern to actually allow one to feel safe going with this one. So I would suggest leave this one alone. Just ignore this one. But for completeness, let's continue. 3.4 billion revenue in 2020, 3.9 billion 2021, 4.7 billion 2022, 5.3 billion 2023, 5 billion falling 2024. And then you've got 598 profits, rising to 697 profits, rising to 122 billion profits, falling a bit to $1 billion profits, and then it goes into losses in 2024. So it rises, peaks here, and it starts to fall. If you look at the margins, we've got 7.5% conversion from revenue to profit. Then it rises to 17.6. It rises to 26. It starts falling to 19.7, and then obviously it goes into a hole of losses. The capitalization is 4 billion. The net asset is 2 billion. It's trading at 1.8 book value, 1.5, 1.3, whatever. And then when you look at the P ratio, it's got, we'll leave that on for a second. We've got 6, 8, 9, and 4. This one is basically, you could argue it's cheap. It's cheap. Share price. 2020, COVID, and then it recovered. 2021, it plateaued for the first half of the year, rose in the second half of the year. 2022, you saw some small rises, and then it basically softened. 2023, it basically plateaued. 2024, you saw it first quarter down, and then started to rise up again. Summary. We said Experian was good for going long because of this 5-day recovery in the last 3 years. Despite that, this number is smaller than what it does in terms of going short. But we explained that even though in the last 3 years going short, we said that the chance of doing well going long was better than going short. So Experian was good for going long. And then what's good for going short? United Utilities. Good for going short. And then we said also Persimmon. I'm sorry, 3i Group. Good for going short. And we said leave this one alone. Leave Persimmon alone. And leave Airtel Africa alone. So you got 2 choices. You either go short with this, you go short with this, you go long with this. And those are this week's opportunities. Let's have a look at the crystal ball. Now, the crystal ball is going to tell us what's happening next week. So let's look at next week. And what we can see here, we have 3 opportunities. Burberry, British American Tobacco, B&M, European Value Retail Stores. Professionals, 96, 54, 23. Non-professionals, 21, 12, 10 respectively. These are your derivative yields. These are your dividend yields. Words of wisdom. Given a 10% chance of 100 times payoff, you should take that bet every time. If you have 100 times chance of winning, so I beg your pardon, if you have a 10% chance of winning 100 times your bet, according to Jeff Bezos, you should take that bet. It goes on to say, most people dismiss many of the best and most profitable investment ideas simply because they probably won't work. These investors never stop to consider how much they could make if unlikely outcomes actually occur. Jeff Bezos took those bets and became the richest person in the world. So this is a very different view, because he's saying, look at the upside and take a chance. Other people, like Warren Buffett, would say, don't lose money, only go for certainty. He's saying, even if you've got a 90% chance of losing, but there's 100 times upside, the 100 times upside makes this risk worth it. Now, did Jeff Bezos have an easy time going from nothing to being the richest man in the world? And the answer was no. He had his journey was a struggle. And you would argue that you have to have a strong stomach to do what he did and pull off what he did. He had to have a strong stomach. He took a lot of risks. He believed in himself and he kept going, but he did take its toll. His wife was very close to him in the beginning, and he lost her towards the end of his journey. And so, you know, he had to pay a price for the dedication and struggle that he had to go through. But for him, from a financial perspective, he says it was worth it. That is all for this week. This is Miles from Milestone Investing. Happy investing. Take care. Bye now.